Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. I'm Matt Miller here in New York City. Coming up, OpenAI employees plan to sell about $6 billion worth of shares to an investor group. That values the company at $500 billion, almost double what it was valued at last time it raised capital. Plus, the Trump administration considers using funds from the U.S. CHIPS Act to take a stake in Intel, so using Biden money to do Trump's work. And we'll take a look at the EV race between the U.S. and China as we await results from Chinese car makers Xiaomi and XPeng this week. But first off, let's take a look at what's going on in the stock market. The NASDAQ right now off just about 0.1%. So although it's coming down a little bit today, it's coming down from all-time highs. 23,695, still quite an elevated level for the NDX. Current and former OpenAI employees are planning to sell nearly $6 billion worth of shares, as I said, to an investor group. And that is one of the top stories that we're following. But before I get there, take a look at what's going on with Intel shares. Right now down about 2.33%, I should say. Intel falling after that news on Friday, and Meta down on a story out of The Information that the company is going to revamp its AI unit for the fourth time in 6 months, splitting it into four, also down 2.33%. Now let's get to that OpenAI story. As I said, current and former employees planning to sell $6 billion worth of shares to an investor group. That's a big number, but the bigger one is $500 billion. The maker of ChatGPT is now, according to sources, valued at almost twice as much as it was last time it raised capital. For more, let's bring in Bloomberg's Kate Clark here on set at 731 Lex. Kate, it's a massive amount considering a month ago it was worth $260 billion. Has it really grown in value that much in 4 weeks?
Not necessarily, but it's really, you have to look at this as a talent wars story. And OpenAI employees are getting offers from big tech companies for tens of millions, even hundreds of billions of dollars to leave OpenAI. Secondary transactions like this help OpenAI retain their talent.
In terms of why we're seeing these big secondary offerings, and at the same time as we're seeing, Mark Zuckerberg paying people $100 million bonuses, is every valuation just lifting out on the West Coast if you're involved in AI programming?
Absolutely, yes, is the short answer. And partly that's because investors are incredibly excited about these companies. They think OpenAI, Anthropic, and others will be trillion-dollar companies like Meta, like Google. And employees, like I said, are getting these offers, so there's no choice but to lift these valuations continually.
So what's the next stop? I mean, why say $500 billion? Why isn't OpenAI worth $1 trillion already?
Right. I mean, it's a good question, and these valuations are pretty arbitrary at times. I mean, jumping from $300 billion to $500 billion is pretty crazy, and I've never seen anything like this. But I think you can expect OpenAI's valuation in the private markets will continue to rise, and who knows how far it will go. So
there's another story from Bloomberg about Meta's offering in AI in terms of a standalone app, right? Does ChatGPT absolutely dominate, or are people using Meta? Are people using Perplexity? Are people using Gemini?
People are absolutely using all of them. People are experimenting, and there are a lot of questions about the durability of the revenues of a lot of these products because there is experimentation, but ChatGPT is one of the largest apps of all time. I mean, the use is undeniable. People absolutely love it. It's part of everyone's everyday now, or most people's everyday at least. So I do think that there's real argument for the future of this company, but I think everyone's correct, too, to be very skeptical of how far these valuations are climbing.
All right, Kate, great having you on this story, and look forward to more reporting. Kate Clark there from Bloomberg News. Now let's get to a story about building AI in the U.S. Hyde, also known as Foxconn, is set to take charge of a U.S. factory owned by SoftBank, setting up what could be the first manufacturing site in the company's $500 billion Stargate venture with OpenAI and Oracle. SoftBank will acquire Hyde's electric vehicle plant in Ohio, but the Taiwanese manufacturer will continue operating the complex, transforming it into a hub for producing AI servers. For more on the broader tech market, including the impacts of tariffs, Ayako Yoshioka joins us, Wealth Enhancement Group Portfolio Consulting Director. Ayako, great to have you on the program. How much of this $500 billion Stargate story is real? I mean, is it actually going to happen in that size?
Hi, Matt. I hope you're doing well. We do think that the, Stargate thing is really real, at least so far. We're seeing it across a lot of the tech companies. There's so many that are involved, but it's such a large number, and we still have to see it come through.
So is this going to be a situation where we have foreign-owned companies coming in here and just operating manufacturing plants in the U.S.? Because it seems like that runs to some extent counter to what Donald Trump was hoping for.
I think any investment here in the U.S. is being looked at very positively. Overall, just digital infrastructure really is something that the U.S. government, needs to make sure that we are at the forefront. Similar to having a strategic petroleum reserve, we really need to make sure we have that digital infrastructure that is strategic, just given, the proliferance of AI, just how it's going to be used going forward. And there's so many unknowns still related to AI.
So are we going to see a jump in employment? I mean, is the Fed going to have to pay attention to this? Or are we looking at, just giant sort of server farms and electric plants that are going to be needed?
Sure. I think we're still in the early phases of discovering what the productivity improvements are going to be. I think it's really clear so far that there are some, but I think there's also some challenges in regards to what is this going to mean for like the entry-level workforce, those kids who are just graduating college, and when knowledge is being democratized because of AI, how do you get them trained? How do you give them the experience that they need in order to validate what AI is telling you?
It does look like, Ayako, this is the tariff strategy is forcing TSMC and Foxconn and other foreign-owned companies to come here and produce. What about American companies like NVIDIA and AMD that are going to have to pay 15% of the revenue on the Chinese business they do? What about these export taxes? How's that going to affect businesses here?
Sure. I mean, I think it's sort of just the pay-to-play issue that we're seeing here. But on the flip side, I mean, NVIDIA noted that China is a $50 billion total addressable market, and I don't think we want to exclude that. And we want to make sure that it's American technology that is going to be the base of overall AI.
I notice in your notes you're very focused on the economic data coming in, the Fed meeting at Jackson Hole, which obviously is key. Rates are incredibly important to your business. What do you expect from Jerome Powell? Are we going to see a policy shift?
I'm not sure if we're going to see a policy shift so much. Perhaps they'll talk about the average inflation targeting that they sort of introduced a few years ago. But, for the most part, we are looking to see if they are going to signal any sort of openness to that rate cut in September that the market's already pricing in, just given some of the, numbers that we've seen so far this year regarding both inflation and unemployment. But that PPI number last week really threw a little bit of a wrench into the story. Yeah,
3.7% on the core. Does 4.5%, does the Fed target rate right now feel restrictive to you?
A little bit. I believe that, in normal times, I think we're looking at a Fed funds rate closer to 3 to 3.5%. And so, having current rates above 4 is still a little restrictive. And you're seeing it with those cyclical companies. I mean, thankfully, most corporations have pretty solid balance sheets, just given the opportunity to refinance back during the COVID years. But we're, 5 years post that. And so having a little bit lower interest rate in order to refinance further is going to be helpful for many of those cyclical companies.
It does seem like cyclical companies, industrials, real estate investment trusts are now far more important to the tech picture than they once were.
Absolutely. The digital infrastructure really is something that investors have been looking at beyond just the actual chips and servers that are powering AI. We're definitely looking at real estate, definitely looking at industrials that provide power, cooling infrastructure, and all of that to the data centers. And so, there's definitely a broadening out. It's just that it's all still related to one major theme, which is AI.
All right. Ayako, great to get some time with you. Really appreciate it. Ayako Yoshioka of Wealth Enhancement Group, talking tech as well as the old economy, because the two are coming together with digital infrastructure. Coming up, shares of Dayforce surge after reports Thoma Bravo will take the HR software firm private. More on that story next. This is Bloomberg Tech. Shares in Dayforce surging today. That's because Thoma Bravo is in talks to buy the HR software maker, according to sources, with plans to take it private in a deal that could be announced as soon as the coming weeks. For more on this story, let's bring in Bloomberg's Leanna Baker. She runs our deals team here in New York. And Leanna, it's interesting because a lot of these software companies, I feel like they need to sell quickly before they're made obsolete by AI.
So that's one opinion, but this company, Dayforce, has been around a long time. It used to be called Ceridian. It used to be private, actually, before 2018. And they make software that helps with HR, payroll, and they have their tentacles deep into enterprises. So maybe they won't be disintermediated right away. There's been a little bit of a surge in deals related to HR and payroll. There was a deal for Paycor earlier this year. Paychex bought that, and ADP also did a deal to buy Workforce last year. So these are just some of the acquisitions that have been happening in the space. We're seeing consolidation, and not necessarily AI taken over.
There's a couple take privates, the Soho House story I'm talking about also today, but is this part of a trend?
These private equity firms have just raised so much dry powder over the years. Thoma Bravo has, tens of billions to deploy. They've been one of the more active acquirers. We've reported they're in talks to buy another company in the tech space called Verint. And earlier this year, they did a big carve-out out of Boeing. So they're definitely one to watch. Orlando Bravo's appeared on Bloomberg TV many times to talk about their strategy of rolling up software companies.
So, and they're one of the more acquisitive firms out there. How is private equity doing in general in terms of making purchases? Because I thought they couldn't find exits now.
That's a great point. We are seeing the IPO market starting to come back, and we'll be watching to see whether there's these candidates that are backed by private equity that could finally exit through the public markets. But so far, a lot of them like trading assets to each other. I mentioned that Dayforce used to be backed by private equity. So T.H. Lee, as far back as 2007, they were backed by another firm. So this would sort of be a return to private equity for Dayforce.
So what's next in these deals? What are you and your team watching out for?
So you mentioned that we reported that this could still be a few weeks away, so there's still news to break. What does Thoma Bravo pay for this company? The company has $11 billion enterprise value, but what's the exact price they're paying? Does this go to up to $15 billion, for example? So there's plenty of details to break that investors will be watching.
All right, Leanna, thanks very much. Leanna Baker runs the deals team for us here at Bloomberg. Now, Swedish AI startup Lovable called itself the fastest growing startup in July, and now it's eyeing nearly $1 billion in annualized sales next year. That's according to the CEO, Anton Osika. Speaking with Bloomberg Tech's Tom McKenzie, he says Lovable's approach to developing allows anyone to be a coder.
I think everyone in the age of AI really have to relearn which tool to use when. And if you are technical and you know how the coding works, you're actually more productive with Lovable. So we're seeing a lot of technical people loving the tool and then being able to talk more productively to the AI. Anyone can learn how to be productive talking to the AI, but there's an advantage for technical people. I think what we're going to see is that everyone is a developer. Like now, there's been much less than 1% of the world population. Everyone is becoming a developer now, and 99% of the best ideas are from people who don't know how to code. So this is for me a very clear example of AI having a positive impact. More people can start successful businesses without being bottlenecked by not having time or the skill set required to build software.
When you think about listing, even it is a further away prospect, Anton, is Europe the place that you would consider, or does it have to be the gravitational pull of the US?
So I'm really betting on Europe, and like one of the reasons we're here is to prove that you can build a world-class team and execute better and faster than from the US. I would love to list in Europe, but I haven't looked at any of the details.
Okay, and in terms of when we look at, for example, Google absorbing Windsurf, and earlier on, of course, in this innovation story, Microsoft absorbing Inflection, is that potentially what happens to you and Lovell? Would you be open to that kind of acquisition where the talent is absorbed into one of the mega cap US tech companies, or is that something you would fight against?
That's something I would fight against. I think most of the value that we're going to accumulate as our the bottleneck right now is on the technology. In the future, most of the value is in the relationship we have with our customers, the trust and the community around it, and that value can only be realized as a standalone entity. So that's what I'm expecting us to continue to be.
That was Lovable CEO Anton Osika. Coming up, Comcast gets serious about its customer losses, but it's a long road ahead. Details next. This is Bloomberg Tech. Comcast has a problem. The company is losing customers in its most significant business, the one that provides internet access to nearly 30 million American households. Comcast has been reporting record losses in broadband subscribers for 3 quarters in a row now. Bloomberg Telecom's reporter Kelsey Griffiths joins us now with more. So, Kelsey, what's the problem? Why is Comcast losing all these subscribers? Where are they going?
That's right. So Comcast is kind of caught in this confluence of several factors. We're seeing competition from the mobile companies as they are offering their own version of home internet service that's boosted by or powered by their 5G infrastructure. We're also seeing the end of the Affordable Connectivity Program, which offered subsidies that Comcast greatly benefited from. It kind of helped boost their subscriber numbers. Now those subsidies don't exist anymore, and those customers have dropped off. And we're also seeing that Comcast has struggled to kind of maintain some of these customer relationships, and that has been a pain point that has led to some of these cord cutters.
So what are they doing about it? How can they turn this around?
Yeah, so Comcast has a multi-pronged structure. They've started a 5-year price guarantee to sort of help lock in some of these customers and give them certainty in what they'll be paying from year to year. What Comcast had been seeing is that customers weren't responding well to the cable subscription model of what some folks like to call the exploding prices. So you sign up for an introductory rate, it's really great for a year, and then you're hit with this big increase. And so that's something that Comcast is trying to move away from, and they are hoping that that will be successful.
So when are we going to see results then? It sounds like obviously a longer term strategy, but when you've had subscribers falling for 3 quarters in a row, I guess investors want you to turn that around this quarter.
That's right. The market is typically focused on subscriber numbers from quarter to quarter. And so the fact that we've seen them falling for the last 3 quarters doesn't look great. Comcast says that folks are responding really well, even though it's still early days. People seem to really like the free mobile lines that Comcast is throwing in to kind of help anchor that bundle a bit more in a more modern service. We also see that people are potentially responding to this price guarantee by upgrading their internet service. They say, look, we know that we're not going to be paying, huge price increases over the next 5 years. Maybe we go up in a speed tier or something like that. So Comcast says that it's still early days, but they are feeling encouraged.
All right, Kelsey, thanks very much. Bloomberg's Kelsey Griffiths covers the telecoms for us. And now let's talk about one of the companies that may be eating Comcast's lunch. YouTube is said to be looking at making a play to host the Oscars. According to sources, the Google-owned video site has inquired about buying the rights to the Academy Awards. For more, Bloomberg managing editor of media and entertainment, Lucas Shaw, joins us now. And Lucas, obviously, YouTube isn't offering you an internet connection, but rather than paying for a cable package, a lot of people are likely to watch TV on YouTube instead.
Yeah, I mean, look, YouTube is the single most popular video platform by any metric, right? You look just viewership on television in the US, it's much bigger than Netflix and Amazon and all the different Disney channels. In fact, people spend more time watching YouTube on a TV than all of Disney's television networks and streaming services combined. That would be the big reason why an award show like the Oscars would at least consider what would be an incredibly controversial move within the Hollywood industry.
So how likely is YouTube to get the Oscars? Because I imagine a lot of Oscars viewers do still have cable television packages or even watch just the networks with rabbit ears, if you get my drift.
The average age of the Oscars is probably a little bit older. Now, some of that is because it's still something you watch on television, and some of it's certainly because it's an award show that I think means more to certain generations than the youngest generation that was raised on YouTube. As for the odds of YouTube getting it, it's hard to say at this point. So Disney, which has had the rights, or ABC has had the rights for about 5 decades, they had an exclusive negotiating window that they let lapse. They had spent a bunch of money getting the Grammy Awards, which some people think means it's likely or at least possible that they will let the Oscars go, which would have been unthinkable previously. And so you now have about a half dozen different companies looking at it: Disney, Paramount, Netflix, Amazon, YouTube, and even Comcast, NBC Universal, which you were just talking about. I would say YouTube, I have a hard time seeing YouTube being the most likely winner. I just don't see why the Film Academy would go with a company that doesn't really have anything to do with the traditional movie business. But if they're thinking about it just as an award show, that's one great way to maximize the audience.
Well, it may be a sign of things to come as well. Great reporting, Lucas. Really love reading your take on the media industry. Bloomberg's Lucas Shaw is our managing editor for that industry. Coming up, Kim Forrest of Boca Capital Partners joins us to talk about semiconductor stocks and what's moving the markets today. This is Bloomberg Tech. Welcome back to Bloomberg Tech. I'm Matt Miller, filling in for Ed and Caroline. Let's take a look at what's going on in these markets. Here's an intraday picture. So that doesn't tell you a heck of a lot, except for the fact that we're down by about 0.25% from what was an all-time high. Obviously, we're at pretty lofty levels here, both in terms of the price and in terms of valuations. Let's take a look at what's going on in specifically chips right now, because the Philadelphia Semiconductor Index, the SOX index, is up even as Intel falls, because Intel's not as important as it once was, right? It's only a $100 billion company, and today it's worth 1% less because of some of the news that we heard over the weekend and some of the moves that we saw on Friday. Let's stick with Intel and semiconductors right now and bring in Kim Forrest, the CIO of Boca Capital Partners. And Kim, this, I think, was one of the most exciting stories of last week, the fact that, at least according to people familiar that we spoke with, the White House is looking at taking an actual stake in Intel and could use money from Biden's CHIPS Act to do it. How do you see that?
Well, I see it as a distinct possibility, and especially because, well, if you look at where the chips are produced, the most important chips in the world, which I can say is probably twofold, of course, AI chips, but also defense types of chips, and not just for the US, but drones and all manner of smart killing machines that they use in the in defense are made on an island 60 miles away from Taiwan, or from China, called Taiwan. And oh, by the way, there's earthquakes there too. So doesn't seem like it would be the natural place to have all your eggs in one basket. And maybe Intel can change that.
Kim, I think it's a great angle, right? The national defense angle. In case we're in a war and someone cuts off those supplies, we're in trouble. Is Intel the right company in which to take a stake? Is Intel the right vehicle with which to make chips?
Well, I mean, I think it's close enough for government work. I love that phrase. Because what does that mean? Well, it's not exactly 100%. Taiwan Semi would be that name because, well, they're on Taiwan, but also they make the world's most exotic chips, and they do it at yields that are impressive. And Intel has struggled to catch up. That being said, it's not out of the realm of possibility for Intel to catch up. And oh, by the way, 75% of their chip making capability is right here in the US.
So how much do you think the US should take, and what are the best plans for Intel? I mean, they did want to build a $30 billion fab in Licking County, Ohio. Is that something that they need to revive plans to do?
I would say maybe look at what they've got, right? I like that approach of incremental as opposed to let's build new. But that being said, I don't really know what the right amount is. I'm pretty much a straight up capitalist. I think companies fighting each other for competitive advantages and trying to serve customers is the best way to go. But I understand that the government would have to own something to be able to give it, essentially gobs of money and maybe some outside support from things that it owns, like maybe the Jet Propulsion Laboratory or other smart government kind of think tanks. So I understand. I don't know. I would not like to see it own a lot, and I certainly wouldn't like to see it, the government dictating Intel's business at a broader scale.
Kim, what's your take on the export tax that this administration wants to slap on NVIDIA and AMD? Because if you look at these things through the national security lens, and that makes sense, that deal would seem like we're willing to sell some national security at a certain level.
Well, we always are. We're capitalists here. And, we have, none of this is new. I've been in the world of software, and you had to go through some pretty strict rules to be able to sell your software outside of the US. And you could get a thumbs down for many reasons, not all that were explained to you necessarily. So none of this is new. So I'm not really sure that this is really selling the top jewels to China through AMD and NVIDIA's kind of B, not A products, but B or C products. So that's one thing. The other thing is, quite honestly, if there's a will, there's a way. I'm sure that a lot of the top-rated chips, the Blackwell chips, are finding their way into China, and in not direct routes, we'll just call it. So let's try to control what we can control. And I think that's a good way to go for not just chips, but software as well.
But as an investor, do you have to watch out for the next company that has to promise a share of its revenue to the, to the White House, but really to the American taxpayer, right, in order to do business overseas?
Sure, well, it does seem like that is the trend here. But the good news is that these chips aren't, they are in demand, and the price is what the price is. So 15% higher doesn't seem like it's a huge barrier to anyone that really wants these chips. The Blackwell chips are a lot more expensive than the chips that we are offering up. So, and they'd rather have those, right? But I don't think it's a huge barrier because the companies are probably going to pass that price along.
In order to avoid much higher prices for chips here in the U.S., big companies like Apple can make, as President Trump told us, investments in the U.S. and get a carve-out. What does that mean for smaller companies that are historically also very important to the development of technology in America?
Sure. Well, I think they have to pay attention to that, right? Right now we're talking about hardware, but software is a whole different category. Oddly enough, Synopsys was forced to guarantee that China can access all of its chip software development tools in perpetuity to allow this Ansys deal that went on. I hope you guys know what I'm talking about. Ansys is a small Pittsburgh company, and but those small companies can be mighty. And I think that everybody that is entering this area as a new company, or the ones that are here, are going to have to pay attention to now being the focus of the government. And it is what it is, and it's just another barrier. It's pretty much the same as any regulation that comes your way.
Kim, great talking with you. Love your intel on this. Really helpful, I think, to viewers. Kim Forrest there is the CIO of Boca Capital Partners. Coming up, former President Joe Biden, you see here, test driving Ford's electric F-150, the Lightning, way back in 2021. But sales of EV pickup trucks still haven't picked up much with U.S. consumers. We'll talk about why and where American car makers stand in the EV competition with China. This is Bloomberg Tech. American car buyers typically love pickup trucks, but not apparently the electric versions. Tesla, Ford, General Motors, and Rivian have all struggled to gain traction in this part of the market. Bloomberg's Detroit bureau chief David Welch has been reporting on this story. And David, I have to say, I'm following these companies closely, and when the unit sales numbers come out every month, I'm shocked to see how small they are for EVs in general, but also the fact that all these companies have tried to get in with pickup trucks first. Why is that?
I think when you had announcements from Rivian and Tesla early on that they were going to go with trucks, I think what everybody figured is the U.S. pickup market is so big that even if a small portion of it went electric, you would still get a pretty big chunk of buyers. And you had all of these reservations, people paying $100 to Tesla or Ford for the Lightning. Tesla said 1 million people, Ford said 150, 200,000 people had reservations, and they tooled up production for that, and GM piled in, and everybody said, geez, this is really going to hit. But those reservations didn't really turn into sales for a variety of reasons. One is pickup trucks lose a lot of their range when you're towing or hauling something, and not everybody uses. In fact, the majority of pickup owners probably never haul or tow anything, but they like the fact that they can, and those who do, particularly commercial users, say they just don't get enough range. They don't get enough driving range when they're actually doing the work their truck needs. And there are political reasons too, Matt. Republicans tend to buy pickup trucks, or I should say pickup buyers tend to be more Republican than not, and EV buyers tend to be more Democrats than not, and a little bit of a disconnect there, so people just haven't bought them in big numbers, and everybody is struggling to sell them.
Nonetheless, the industry keeps pushing towards this. In fact, I was talking to Jim Farley yesterday. He was out at Pebble Beach, and he's touting this new affordable, it's a mid-size pickup, so not a full-size American machine, but a mid-size pickup that they'll build in Kentucky for $30,000. Why do they continue to push towards this goal?
Well, price is one of the big problems with pickup trucks. I mean, you look at GM's trucks, for example, they can go 500 miles on a charge, the Silverado and the GMC Sierra EVs. That's quite a ways. And they do lose a lot of their range when you're towing a decent amount of weight, but that's still 300 miles you can go if you're hauling something. That's pretty good, but the trucks are very expensive. So if you're a fleet buyer or if you're just an individual consumer, you're looking at paying another $10,000, $20,000 for the electric version, and you don't really get anything more for that other than EVs are pretty fun to drive, but a lot of truck owners also like the hum of their V8 too, as opposed to the silence of an electric motor. So they're just not getting enough for that. You get the price down to $30,000, even for a mid-sized pickup truck. That's kind of where you're looking at Ford Ranger and Chevy Colorado mid-sized pickup trucks. That's where they're selling, roughly speaking. then you'll get some more sales. GM's doing something similar. They're going for a lower range pickup truck, 400 miles instead of 500, but should sell for thousands of dollars less. So everyone's trying to get that cost down because that is one of the big barriers with these vehicles.
Right. Slate, for example, going for a much lower range, but also a far lower price. Is an interesting startup as well. David, as always, I look forward to your reporting. Bloomberg's David Welch, Detroit bureau chief, covering, since he's in Detroit, for the most part, cars. Let's stay on that to some extent. Shipments of China's rare earth products reached their highest since January last month. The increased supply comes as Beijing agreed to resume sales to the U.S. as part of a trade truce. Earlier this year, China curbed flows of 7 rare earth products made there in retaliation to U.S. tariffs. That's a move that raised concerns about a global shortage, and it hurts particularly the car industry, the electric vehicle makers, because rare earths are so important for really ICE and EVs. Let's stick with the global competition in that space and bring in Ellen Hughes-Cromwick. She's a visiting fellow at Third Way's Climate and Energy Program, former chief global economist at the Ford Motor Company. And Ellen, this is so critical. We were just talking about the importance of semiconductor manufacturing, and at least there's a solution, right? You can actually make them in the U.S. But what about rare earths? Is it possible to have a scalable business that manufactures rare earth magnets in the U.S., or is it just too dirty?
Oh, hi, Matt. Great to be with you. No, we have plenty of rare earth. The question is when, not if. It takes a long time to get to a point where you're harvesting and you're refining. We've learned that with some simple critical minerals like lithium and some others for the auto industry. So I'm firmly in the camp of, hey, if you want to do it, you can lift it and refine it, but it will take some time to get that infrastructure in place. And really, that's been one of the bottlenecks for EVs in general, which is, you've got a very complicated industry. It's making a transition. It takes a substantial amount of time to do that.
So this is another area where the Trump administration is buying into private industry to help push it along. MP Materials is one company in which they've taken a stake to do that. Do you believe we need a real government push in order to be refining rare earths here?
Well, if you think about public finance theory, and I just want to put this on the table, if you think you have a market failure or you got a negative externality, it's very simple. There's a role for government intervention, but we got to stick to those principles. And if, in the case of these things where, we have a public good, which is our climate, it's a public good. We consume it. Everybody does every day. And if you think that public good has to be protected, then there is a role for government policy. And I just stick to that framework and those principles. And I think those are important tests for understanding where we need public policy and where we don't need public policy.
So we've seen, Ellen, Ford has to pause production at some of its factories over the past few months because they can't get a hold of enough rare earths, enough magnets to make the vehicles that they need to. I'm sure other U.S. manufacturers have had, if not pauses, similar problems and frustrations. How long until you think we can get the U.S. refining infrastructure up to speed so that we no longer have issues like that? Are we talking just a matter of years or decades?
Matt, I really think it's going to be in a 5 to 10 year time frame. I mean, it really takes that long. We had a great acceleration in the transition to EVs that started after 2010. It grew exponentially toward the back half of that decade. And we're now at about a 10% market share. This has been a, month in, month out, gradual increase, even though July EV sales were surging, obviously, as customers wanted to take advantage of the tax credits before they end of next month. It will continue to gravitate higher. But, without the IRA tax credits, this is going to slow it down. And, it doesn't seem like, from a competition standpoint, and like you were just talking about, like get sourcing domestic for a lot of reasons, not just the climate, but national security. We got to move in that direction. So let's make sure we got the incentive structure right.
Ellen, great to talk to you. Hope to get you back to talk more about this. Ellen Hughes-Cromwick, Senior Visiting Fellow for the Climate and Energy Program at Third Way, formerly at Ford. Coming up, what's in store for Apple's Vision Pro after adoption has been slow to pick up? I'm sure that you don't have one. That's next. This is Bloomberg Tech. Apple has slow-walked the release of immersive video, creating a conundrum for the Vision Pro, which remains an extremely niche product. Here to discuss the future of the Vision Pro and the latest Power On newsletter is Bloomberg's managing editor in consumer tech, Mark Gurman. Mark, it's interesting because they have this hardware. Now, it is expensive and heavy, right? But they don't have a ton of software for it. Is that the case?
Yeah, that's right. And, taking a step back, we've never seen Apple launch a major new product category that they've spent nearly a decade and nearly $10 billion developing sort of flop like this, right? The Apple Watch was a little slow out the gate, but pretty quickly, within a year or several months, it started to go mainstream. The iPod quickly went mainstream. The iPhone ticked up pretty quickly. The iPad was a blockbuster out the gate. So this is going slower than I think even Apple anticipated to some degree. The best feature on the headset, to your point, is the immersive video content, some of the stuff we're showing on the display right now. But it's very limited. They have a few series. They only have a few episodes for each of those. They've only released 27 pieces of immersive content in the last year and a half. And it's a conundrum. It's very expensive to make, but why invest all that money in it if the headset's not selling well? On the other hand, that's why people would buy the headset, because of that immersive content. So they're a little stuck here.
Well, I mean, there's only so many hours of entertainment I can get out of like a dinosaur or Bono, right? So why don't they either make more content for this thing or put it on hold until they're really ready to sell a product we need or can use?
Well, here's the thing. Let's say the Vision Pro line doesn't take off for another 2 years. In 2027, they're going to release a much lighter, completely revamped, cheaper version. So if they put out a bunch of content now and pile up all the content now, by the time people actually start using the platform, right, in 2-3 years from now, all that content is going to be outdated. They're going to refresh the Vision Pro in the next several weeks here, right before the end of this year, with a faster processor and a new strap. That's going to make it faster, more capable for applications, probably improve immersive video content, improve 3D video. It's going to make it feel a bit lighter when you're wearing it on the head. So a bit of a marginal improvement, but the real changes are still far out. But again, the end game here is augmented reality glasses. This is going to be table stakes for all the tech companies within the next 3 to 5 years. Google's working on this, Samsung's working on this, and Apple has been working on this for several years. The original concept for a headset for Apple was glasses, but they're not going to release glasses until they can get some visual quality, right, on par with the Vision Pro at the thin and lightness of a glasses form factor. That's still going to take quite a bit more time.
All right, Mark, thanks very much for joining us. Bloomberg's Mark Gurman there. You can check out his Power On column to get the inside scoop on everything Apple. That does it for this edition of Bloomberg Tech. Don't forget to check out our podcast. You can find that on the terminal as well as on Apple Podcasts, Spotify, iHeart. And check out my podcast, too. It's called Hot Pursuit with Hannah Elliott. If you care about cars, search for it. I'm Matt Miller. This is Bloomberg.